So welcome everyone. Thanks for joining me today. Thanks for taking some time out of your busy schedules to learn a little bit more about Onward Financing. For those of you who don't know me, my name is Tom Meckey, and I work with Onward as the Vice President of Sales and Marketing, and my main responsibilities are business development, partnership with real estate agents like yourself. So thanks for being here. The topic of our webinar today is how to work with Onward Financing to get clients off the fence. All right, and we'll talk a little bit more in detail about how we do that through our financing programs. The mission of Onward Financing, for those of you I haven't spoken with in the past, is to make homeownership simpler and more affordable. That's really what we exist to do. My background, I've been in real estate for 17 years. I hold a broker's license currently at Lake Sotheby's International Realty. I actually started working with Onward a couple of years ago as an agent. And how I ended up coming to work here full time was I started referring clients to Onward because they had such amazing programs. It enabled me back in 2018 to sell about 6 homes I never would have had the opportunity to sell had it not been for this company and their tools. So, just a little bit of background. I started talking with a gentleman that founded the company, and we started talking about how to increase outreach to the real estate community, and all of a sudden I ended up here, and I'm really excited to be here. So it's been a great transition in my career, and I really enjoy partnering with my colleagues in the business that I've gotten to know over the years. So Onward's main mission is to kind of change how homes are financed. Okay, what makes us different? You'll see the bullet points on the side of the screen here. I mean, we open up the market for more people to buy a home. And we partner with real estate agents that want to sell, more and for higher prices. And we consider the home when evaluating a loan more than we consider a borrower, right? More like an equity-based lending perspective. Our belief is that real estate agents add a ton of value to the real estate transaction. It's a very technical transaction. We want to keep our real estate agent partners in the transaction versus some of the other companies that are entering the space and putting pressure on our livelihoods here. And we can talk about that more in detail in a little bit. But we maintain that sellers should get full value for their homes. They should be able to find the perfect home on their timeline, and underwriting should adjust as buyers' needs adjust. And if you go and look through the lens of your typical Fannie Mae or Freddie Mac underwriting guidelines, it doesn't. It makes it very, very hard for people. So lenders should value the whole picture when qualifying for a mortgage, not just the Fannie and Freddie underwriting guidelines of your typical borrower application. Okay. So if we look at what are the things in today's market that are deal killers, okay? Market conditions continue to favor sellers right now. I mean, we all know that, and they're going to for the foreseeable future. Borrowers that have conditions including FHA financing are at a significant disadvantage in competitive situations. I hear from a lot of you, hey, do you guys have any programs that can help FHA and VA buyers? Because when you're in a multiple offer situation with an FHA or VA buyer, it's really challenging. And so it creates a real problem for those who are trying to take advantage of FHA financing in the current market. Homeowners are unwilling to sell because the uncertainty of finding a new home. I think we all know that there's a chicken and egg thing going on for people right now. Obviously, homes are selling. We're seeing multiple offers, and in one day, people are going in crazy amounts of money over the asking price. So it's not the fear of selling; it's the fear of finding. Okay, and one of the challenges is that particular homeowner who has to sell in order to be able to buy. So it's just like, okay, I know my home's going to sell, but I have to write an offer that's contingent upon the sale of my home. in order to be able to buy. And a lot of people, that creates a lot of fear for people. And what we've done is we've created solutions to help mitigate that fear and take that stress away. And I'll get into how that works here momentarily. Okay. Just a little bit about the market. If you look at where the median sale price has gone in just 2 short years, from 259 back in 2019 to now above 300, I think we're in this market for a little while, and the lending industry needs to catch up to the needs of the agents and the buyers in the marketplace. So that's what we intend to do. Inventory of homes for sale across the market has plummeted. Last I checked, there was about 7,000 active listings in the 7-county metro, compared to the same time back in 2010. There was about 22,000 listings for sale. So the market's getting more and more constricted with the low inventory. And the pending sales obviously are continuing that upward trend. Okay, I'm going to skip past this. So what is this doing to the market? Well, so a lot of people are sitting it out. Buyers are driving home prices higher. More buyers are driven out of the market because of that, and more than a half of home sales have multiple offers on them. To win in this market, you need a competitive, attractive offer without contingencies. Homeowners who put their house on the market after they have found the right home. That's what you need. That's what we need people to be able to do. We need them to be able to confidently go buy a new home so that they can put their departing home on the market. Okay. So the seller's sources of fear are all around the contingencies that a buyer might have, right? So in the current market conditions, a seller doesn't want to work with a contingent buyer, and lenders dictate contingencies on home purchasing financing through automated underwriting and through Fannie Mae underwriting guidelines. The big fear for people that are going through this move up process, or even a downsizer, for example, is cash flow. A lot of people can't afford to pay 2 mortgages until they sell a departing home, or the strain and expense of temporary housing is something that'll knock somebody out of the market. They'll just say, you know what, I don't want to mess with all that. In order to qualify for traditional Fannie Mae or Freddie Mac conventional financing, I got to sell my house first so that I'm not contingent. I got to put all my stuff in storage, then I got to go find temporary housing until I can find a house that I can buy. And the prospects of going through that just don't appeal to people. And then the uncertainty of selling a house keeps buyers move up buyers from entering the market. So Onward has developed a series of products based on different homeowner personas, a move-up buyer or a downsizer. We have a program called our Mortgage for Movers program. We have another program called the Mortgage for Downsizer program. They're very, very similar. What Onward does is we eliminate the debt on the departing home, and we free up equity for a down payment on a purchase money mortgage on a destination home. Okay, so we remove the existing mortgage from their debt to income calculations. This allows a homeowner to qualify for a traditional conventional financing like a qualified mortgage. It frees up cash for a down payment on that new mortgage. And the results are a faster purchase that allows people to get a home that they want on their timeline. And it helps real estate agents, convert at a higher rate with the clients that they're trying to get into a house. The nice thing about our program is there's no payments on it. Okay, it's fee-based. So you don't ever have 2 payments, right? So we pay off that existing mortgage. We allow, from a not to get too in the weeds on how this works, but basically it's treated like a cash out refinance without any payments. All right. So we're taking care of that existing mortgage. We're removing that from their debt to income calculation. If they're in a strong equity position, we allow to pull cash out for a down payment so that they can go make that purchase money mortgage not contingent upon the sale of a home. Then you get that offer accepted, you move them towards closing, and if they choose to wait to put their home on the market till after they move into the new house, they can, or they can just get their home listed on the market and get it sold and try to align close dates. So we provide a lot of flexibility, but the big benefit and feature of our program is that we remove the obstacle of the contingency without having to actually have that house sold, that departing house. Where our Mortgage for Movers program really applies, I want to be clear with everybody on the call. This is not a program for the entire market. Okay, this is a program that is for that strong credit home buyer who has a strong equity position in their home. All right. If somebody's house is worth $250,000 and they owe $225,000 on it, this program doesn't work. Okay. Where this applies is in multiple offer situations for people with good credit, or for homes where staging and emptying, where staging and empty showing will increase the sales price, and for families in which temporary housing can just trying to do temporary housing is just an overwhelming endeavor. Okay. How does our Mortgage for Movers program compare? We make the claim that it's a 10 times better solution for consumers than, say, an iBuyer program would be. We really see this as the anti-iBuyer solution. We've done a deep dive on iBuyer companies like Zillow Instant Offers and Open Door, and they're just not good deals. They're really not good deals for homeowners. The average cost of an iBuyer program to a homeowner is anywhere from 15 to 18% of the value of their home. So I could make the argument that the iBuyer, that our program is 10 times less expensive, just looking through the lens of the cost of the program through Onward. It doesn't take into account transaction costs like real estate commissions and things like that. It really is just comparing, should I take this iBuyer program or should I go with this Onward financing program? The reason why we compare our Mortgage for Movers program to an iBuyer is really it helps people get the same outcome. If you ask a homeowner why they would choose to take an instant offer from a Zillow or an Open Door, they'll tell you convenience, ease of use, and most importantly, certainty. They're certain that their home is going to sell, and they're certain that it's going to close. Okay. And a lot of people are really willing to leave equity on the table for that certainty and ease of use. We argue that there's a better way. I think that I've gone through some of these iBuyer programs with clients. I think the service level is somewhat diminished in terms of the advice that they get from the players that are involved. I maintain that the real estate transaction is a very technical transaction, and people should have good professional advisors that are representing their interests, that are helping them get their home exposed to the entire market so they can maximize what the market will yield. Our programs help agents do that for their clients. And more importantly, we really do want to keep the real estate agent involved in the transaction. And this is a way in which it's done. So what does a typical Mortgage for Movers program look like in terms of cost to the homeowner? Our fees are straightforward. Our fees, there's an application fee of $495 that basically we collect up front in order to cover the cost of an appraisal. We have a fixed cost to administer this financing solution, and we basically pass those costs back to the homeowner. So the only out-of-pocket upfront expense is the $495 application fee that we use to cover the cost of the appraisal. Then there's an $895 underwriting fee and a $500 processing fee that can be wrapped into the loan, so they don't have to cut a check for that. And then the cost of the financing. Basically, it's like a daily per diem cost, and the charge of that is $22 per day per $100,000 borrowed. So a $200,000 loan would be $44 a day. A $300,000 Mortgage for Movers loan would be $66 a day. The average amount of time over the past 2 years, the average amount of time an Onward client has had this financing out has been 63 days or less. So the easiest way to calculate what the per diem cost would be is to take whatever their loan amount is multiply it by 8%, and divide by 365. And that is the number of days in a year. And that's how we calculate the per diem. You guys get the home ready for the market, you get it sold, you get it closed. We calculate the number of days that they had the financing out. That's what is paid, and then all the remaining equity is refunded to the client. Okay. The benefit of this is we argue that people sell for more because they're not compromising on a sale price to meet a close date. Oftentimes, when people are buying a home and selling a home, they have that stress. They just want to, they want to avoid that 2 payments, or they have to get the 2 closings lined up in order to be able to, close on a purchase money mortgage. So what they do is they list their home aggressively on the low end, so that they can avoid, carrying it and, can leave money on the table. This also gives gives our real estate partners the ability to professionally stage and photograph a home and prepare it for the market so that it does command a market premium. And then it also it allows people to buy when they find the right home and to be able to do it without stress. We also have some agent programs. A lot of our agents have taken the approach of building our fee structure into listing commissions to create a buyer. I can talk with agents on a one-on-one basis on how to do that, but it really is up to you on how you want to structure it. Okay. How agents can work with Onward Financing. So our goal is to help you sell more homes to people that deserve home ownership. I want to be clear. We are really looking to work with people who should be in a home ownership position. This is not a program for anybody and everybody. We want to set people up for success, right? So we are gonna do a full evaluation of a client and make sure that home ownership is right for them from a financing and affordability standpoint. We want to verify income, assets, down payment, credit score, employment. We work with self-employed borrowers. That all of that is in place, but we want to make sure that people have the capacity to repay so that they're set up for success. Last thing we ever want to do is be in a situation where we're taking a property back from somebody. Access. And just going further into this, what we do to help agents is, we provide you access to our products, co-branded marketing materials, and partnerships to invest in, real value building opportunities in the marketplace. So it's really important that we collaborate with one another when working with clients and, just make sure that everyone's set up for success from the get-go. Does anybody have any questions about how our program works? Don't be shy, guys.
Tom, I had a question. This is Larry Eberhard.
Hey, Larry.
The $495 fee, I think, appraisal fee, that's the appraisal to be done on the departing house. Is that correct?
That is correct. Yeah. Yep. So we do an appraisal on the departing home for 2 reasons. One, we're placing private capital, and we're securing private capital against that departing residence. So our investor partners require us to have that appraisal done. There's a side benefit to having to that in the process, and I'm sure none of you have ever had this problem, but maybe you have a seller that has an overinflated perspective of what their home might fetch in the marketplace. What's nice about having the appraisal is it really is it's an independent third party who's coming in and saying, hey, this is, based on, current market, this is what this home should fetch, right? Now, I'll be the first one to acknowledge sometimes appraisals come in low. They are backwards looking in terms of how they value homes, and they don't necessarily take into account current market conditions. So we also work with our real estate agent partners to look at current market conditions. So if you provide me with a good CMA and you say, hey, look, here's what's going on in this neighborhood, we can work with that as well. So we really do collaborate with you as the professional in the transaction to help guide us on that. But yes, the $495 long answer to a simple question, That is to cover the cost of an appraisal on the departing home. I just wanted to give you some more context as to, why we do it. So Ann says, what's the best way to get started? Can you give some examples? We can share real life examples for clients. And I do owe Ann a spreadsheet on a couple, she and I spoke last week, and I owe Ann a couple spreadsheets on some examples that we can use or that for her clients. What I'll do so some of the spreadsheets that I have right now have borrower information on them that I have not blacked out. So for the purposes of borrower privacy, I won't share a real life example, but what I can tell you is there are additional fees that are associated with doing this. Some of those fees are title fees, for example. We don't really factor that into our cost because it is an independent third-party cost, and they can, your clients can work with any title company they want. But this is treated like a refinance, okay? So you can go on any title company website and use their, if they have a calculator, like we use Ancona Title quite a bit. Ancona Title has a calculator app on their website, and you can plug in any address and loan amount, and it'll give you a very accurate representation of what title fees would be. As far as our fees go, what I presented in my presentation, those are what our fees are. You basically have those basic administrative fees. That's our cost to administer the financing, and then the per diem cost on the loan. I want to also make a point on this so that you guys can help manage people's expectations if you refer someone to Onward. The reason why we do it the way we do is so that we don't have to calculate the debt on that departing home in a borrower's debt to income ratio based on Fannie and Freddie underwriting guidelines. So if you've ever dealt with like student loans that are in deferment, you still have to calculate 1% of the student loan balance into someone's debt to income ratio, because at some point they are going to have a payment. All right. That's a Fannie Freddie underwriting guideline that you can't avoid. So what we've done is we front end loaded the loan with fees. And that way when we say there's no payment, it's basically on an accrual basis. That way we don't have to factor it into the debt to income ratio. And that's how we're able to get them approved for financing to purchase without selling first. So that's how that works. Scott asked a question. Please clarify the length of time a homeowner can take to search for their new home. Great question. So this loan doesn't fund until you get a new home under contract, and we fund about 7 to 10 days prior to the closing of a purchase. So once we get them approved for the financing, if it takes you a year to find a new house, you can have a year. The key is, as long as there's no change in their credit score, there's no change in their employment status, and their income remains consistent, they can take as long as they need to find a new home. Once you find them a new home and get it under contract, that's when we start the underwriting process of doing the mortgage for movers loan on the departing home. Is there another question here from Larry? Is there a general rule of thumb in terms on how much equity a homeowner needs / should have in their existing home to be a good candidate for the MFM program? Great question. Yes, there is. So our underwriting guidelines are that we will lend up to 80% loan to value on a departing home. What that means is, let's say you got one that's worth $300,000. We will issue a loan up to $240,000 on that departing home. So from the 240, whatever their existing mortgage balance is, we pay that off. And whatever the delta is between that amount and the mortgage payoff less our fees is what they have for a down payment. Now, one point to make clear, the remainder of the equity that they have in that departing home, once you get it sold, they can apply that to their new mortgage, and they can recast their payments based on that infusion of equity from the old house into the new loan, so that they, we might have to write them, a purchase money mortgage with a lower down payment, which might result in mortgage insurance. But if they have enough equity to remove the mortgage insurance premium after they get the home sold, they still have the ability to do that. Hopefully that makes sense. Yeah, there is a recast feature. So once they put that equity towards the new mortgage, we'll recalculate it based on the new principal balance and interest rate that they locked into, and the payments will go down, and that's how that works. Anybody else? One other thing I wanted to let you all know about is, so we have other programs outside of our Mortgage for Movers program for move-up buyers. We're working with a lot of seniors who've been in their home for 30 years. They own it free and clear. They want to downsize into a condo, but they want to find that condo or townhome before they sell the home they're currently living in. Again, we'll work with you. You determine a value that's, conservative and realistic for current market conditions. We'll lend up to 80% of that so that they can have cash to go buy a new home on a downsized basis. And if they need a small mortgage, we can write that for them. I want to be clear, we don't just do non-QM, non-qualified mortgage lending. We have a vast array of mortgage financing products, from FHA to VA to USDA, conventional financing, jumbo loans. We have home equity conversion loans as well, also known as reverse mortgages. And we're in the process of developing more products to help meet the needs of real estate agents in the current market. Those I don't want to get too much into detail on that yet, because we're still working on developing those products, but we'll go from there. All right, somebody said, when we have clients who we believe would be candidates for your programs, what is the best way to put them in contact with Onward? So I would encourage you to drive your clients to our website. And on our website, there's a button that says Let's Talk. If they click on Let's Talk, they can fill out a form. They can tell us in the form who the referring agent is, so that we make sure that we get them out to you. And then we have a commitment that when you send a client to us, we'll respond to that client within an hour. Just acknowledging that they filled out the form and that they want to get going on the process. I have a team of really great lending advisors. Currently, we have 6 loan officers that work with us, and I have 5 new MLOs starting with us in the next 2 weeks. So we have a team that's growing, that's here to serve you. Can you speak to products for independent contractors? Are those loans still under Fannie and Freddie Mac guidelines? So Karen, thanks for that question. Yes, I can speak to that. So independent contractors, I feel like you're referring to self-employed borrowers. And yeah, we have portfolio lending programs for self-employed borrowers. I can give you an example of a past client that I have. A gentleman named Grady Hanna. He owns his own business, and he runs a medical tech company, and he just didn't qualify. And he had great income, great assets, 25% to put down. Went to every bank in the Twin Cities, and nobody would approve him. We approved him on one of our portfolio loans. Definition of a portfolio loan is a loan that we lend our own capital and we service it. So we do have portfolio lending programs for people that don't fit inside Fannie and Freddie lending guidelines. We'd like to see a 20% down payment for those loan programs. We like to see strong credit, and we like to see good cash flow. But it is an equity-based lending approach, so that should be able to. Hopefully, that answers your question, and applies to what you're looking for. As far as marketing programs, so we have a couple of really great marketing people, Sarah Biskin and Kevin Palmstein, who are constantly creating co-marketing tools for our agent partners. We've invested in a system called HubSpot. where we can create co-branded landing pages for you and your clients. What's nice about HubSpot and those co-branded landing pages is that we know exactly where that referral came from, and when the applicant comes through a HubSpot landing page that we put together for you, we know who to send it back to. We get a lot of people applying with us all the time, and sometimes we don't realize who referred us. We're always asking the borrowers, please tell us who referred you so we can get you back to the right agent. We also have trifold brochures that can be co-branded. Sarah can put those together if you give her a fair amount of notice. Like, for example, if you're doing an open house and you want to have one of our trifold brochures, which everyone who's on this call today will get a PDF example of that. We'll email that out to you. But if you want to get a trifold brochure co-branded with your picture and contact information on it, we can provide that to you. We can provide you with the resource for printing it, or you can print it yourself. It's completely up to you. But we do provide programs for our agents on that. Question from Scott Belcher. Is the Mortgage for Movers a nationwide program? Example, homeowner relocating from Florida with home to sell first. So it is not yet nationwide, but we intend to be. We are in the process of getting licensed in Wisconsin. We will be regional this year. We'll be, our goal is to be licensed in Wisconsin, Iowa, the Dakotas, Colorado, Arizona, and Florida in 2021. And within the next 5 years, we intend to be in all 50 states. Question from Babette Castilli. What are the benefits of this program over a line of credit or swing loans? Great question. In certain instances, a lot of people don't qualify for home equity lines of credit. A home equity line of credit would definitely be a more cost-effective option than our option. The challenge with home equity lines is that they come with prepayment penalties, although they're not very expensive. Typically, like a prepayment penalty for a home equity line of credit at US Bank is probably $500 if you close it within, it's either 36 or 60 months. I think it's 36 months. But you have to answer a question. They're always going to ask, do you intend to sell the house? And if you say yes, they're not going to give you the HELOC 9 times out of 10, right? And then the other benefit of this program is it's for the person who doesn't qualify for both payments or doesn't want to have 2 payments. It's really designed for that borrower who doesn't want to carry 2 mortgage payments. Hopefully that helps answer your question. All right. I'm just scrolling through the chat here. I got another one here. Are your portfolio loans at a competitive interest rate? Yes, they are. Yep, they are. I mean, they're not going to be in the low. They're not going to be in the 2s, like what we've been seeing. That being said, I actually think more conventional mortgage rates have actually crept up into the low 3s. A lot of our portfolio loan rates are at a higher interest rate, but they are competitive. And the rate pricing is a case-by-case basis. The example of the gentleman I referenced earlier, I think his interest rate was somewhere around 5%. We've had people at 3.5 to 4.5. It really is borrower specific based on a lot of the factors. Depends on down payment. It depends on the length of time. There's a lot of factors that go into rate pricing, but our portfolio rates are competitive. Do you end up with the end loan on this program and that's the only way it's available to our clients? Yes, that is a good question. So we do end up with the purchase money mortgage on this program, and legally we can't require that. From a technical perspective, they can shop for a qualified mortgage with anybody. The challenge that you're going to run into is another lending institution's ability to close that loan with our program. They're not going to know how to structure it. So we highly encourage and recommend to agents and their clients, if you're going to work with Onward on the Mortgage for Movers program, you really should work with them on your purchase money mortgage. we're very competitive on qualified mortgage rates. So conventional Fannie and Freddie based financing, we're right in line with the rest of the market on interest rates and closing costs and things like that. And we even have a price match guarantee. So if you're out shopping and some other lender gives you a really good deal, we want to make sure it's an apples to apples comparison, and they're putting all the appropriate costs in place, like title fees. They estimate the right amount of escrows and insurance, things like that. But yeah, I mean, it's going to be in their best interest to work with us on both. Can't require it because that you can't make one contract subject to another from a compliance perspective. But you're going to have a very hard time getting that purchase money mortgage closed with another lender. And it's because of the underwriting issues that they're going to have with not counting the loan balance of the mortgage for movers loan on the departing home in their debt to income ratio. How we've been able to figure that out with our wholesale lenders is kind of the proprietary secret sauce, if you will, on our program. So hopefully that makes sense. Okay. So we are at 12:15. We've been at it for about 45 minutes. If there are no other questions, we can conclude this webinar, and we'll definitely be available for follow-up questions. I'll make my team readily available for questions, and I will get you those scenarios that you emailed me about from our conversation last week. So
appreciate that.
Yeah, I haven't been ignoring you. We've just been inundated. So there's a really nice guy, Jamie Hemberger, that I had given your contact information to Jamie. He works with us, and I'll have him follow up with you as well. So he's okay. Great. He's great.
Thanks, Tom.
Yeah, you bet. Thanks for attending. I really appreciate you being here.
Absolutely.
Are there any other questions from the gallery here? Well, stay tuned, everyone. I'm excited about some programs that we have coming down the pike here, and I think in a very short time, we're going to be rolling out some new programs to help buyers, not just move-up buyers, but all buyers that are in competitive situations. We're working through the logistics on that, and I'm confident that the next month we'll have some pretty exciting news to report. So with that, I'm going to conclude our Zoom. Thank you. If anybody needs help with any clients this weekend, let us know, and I'll have my team ready for you. So thanks, everybody.